So if you don't really buy or sell real estate, you probably don't need to know what a 1031 exchange is. However, if you own real estate, flip or rent properties, or you're in the real estate business such as a real estate broker or mortgage loan officer, you absolutely need to know about this. A 1031 exchange, also known as a like-kind exchange, is a provision in the U.S. Internal Revenue Code, specifically referred to as Section 1031, that allows real estate investors to defer the capital gains taxes owed when they sell an investment property and reinvest the proceeds into a new property which is similar or like kind. Deferring paying taxes on capital gains makes the 1031 a very powerful tool, and it's used all the time by real estate investors to dramatically grow their wealth and potentially put off paying taxes indefinitely. The exchange does come with strict rules on how you can execute it, and in this video I'll describe all the details so you're well aware of how it works. Hey, if you're new to the channel, my name is Elliot. I'm a long-time investor and financial advisor. I create helpful videos just like this one to make you smarter about your money, so be sure to like and hit the subscribe button to stay on top of all the new releases. And now let's get back to the video. Okay, so when you sell a property after holding onto it for some time, it would likely have appreciated in value compared to when you first bought it. This isn't a whole lot different from the stock of a good company. When you sell that stock, you have realized capital gains, and that of course is taxed. So it goes with investment property, and you will likely owe some taxes on the amount that appreciated when you sell it. The 1031 exchange simply says that you can defer paying those taxes if and only if you then turn around and use the profits to purchase another similar property. So why did the IRS create this generous rule? It was created to encourage investment and reinvestment in the real estate market. The provision means investors can avoid immediate tax burdens when exchanging properties, which can free up capital for further investments and potentially boost the economy. So this is the basics of the 1031, and it's fairly straightforward in theory. However, I did say earlier in the video that it comes with strict rules, and we need to cover them in some detail as they can make a huge difference in how you execute a 1031, or if you can even do so in the first place. The absolute first thing you need to know when it comes to these rules is what exactly qualifies as a like-kind exchange. Essentially, the new property has to have the same nature, character, or class, but not necessarily the same quality or grade as the one you are selling. This new property also has to be similar in function. So for example, a multifamily apartment property can't be exchanged for a single-family vacation home, as these are fundamentally different in nature, character, class, and function. The second thing you absolutely must know is that 1031 exchanges are generally only for business or investment properties. Property for personal use, such as your home, typically doesn't count. Securities and financial instruments such as stocks, bonds, and other debt instruments also usually aren't eligible for 1031 exchanges. Here's something else to keep in mind. The most effective way to make use of the 1031 is to purchase a more expensive property where the sale of the old property will not leave any cash in your pocket. That is, after all, the whole point, to upgrade while deferring taxes. If you buy similar but less expensive property, you will then have cash left over, and in real estate lingo that's called boot. And guess what? You will owe taxes on that boot. Okay, so far so good? Well, there's more. The next thing you need to know about are 1031 exchange timelines. There are two timelines to keep in mind, the 45-day rule and the 180-day rule. The 45-day rule says that you have 45 days after the sale of your relinquished property to identify the replacement property, and you must identify the potential replacement property in writing. The letter must include a legal description of the property signed by you and shared with the seller. The 180-day rule says that you must close on that replacement property within 180 days of closing on the relinquished property, or after your tax return is due, whichever is earlier. The 180-day time limit for 1031 exchange is a strict deadline. The IRS really doesn't want you sitting on that cash without paying taxes, so if you don't meet it, you may be subject to capital gains tax on the profit from the sale of your property. Finally, there's one more important rule, and that is that you must work with a qualified intermediary, or QI, who is sometimes referred to as an exchange facilitator. Basically, they are a neutral third party and they hold the funds in escrow for you until the exchange is complete, thus assuring that you are not sitting on cash that could trigger tax liability. A QI is also responsible for a number of other critical items such as coordinating with the seller, conveying the title, and much more. Who can be an intermediary? Typically, it's a specialized escrow or title insurance company, or it can be a bank. You yourself cannot be a QI, nor can a relative or anyone who acts as your agent, such as an accountant or attorney, unless their services were solely related to 1031 exchanges. Okay, we went through a lot of rules. Now let's put it all together and cover the steps needed in executing a 1031. Step 1 is to, of course, identify the property you want to sell, followed closely by step 2, which is to identify what property you want to buy. Step 3 is to identify the QI, which I discussed a minute ago, and finally step 4 is to go through with the transaction transaction while keeping an eye on the calendar timeline. After you're done, be sure to file IRS Form 8824 with your tax return. In that form, you describe the properties, provide a timeline, explain who was involved, and detail the money transactions. Now, when you are ready to execute the 1031 exchange, keep in mind that there are 4 types: a simultaneous, deferred, reverse, and improvement exchange. I'll do a quick overview of each, but you will really need the assistance of an accountant to make sure you don't inadvertently make errors during the transactions. So in a simultaneous exchange, the buyer and the seller exchange properties at the same time. In a deferred exchange, the buyer and the seller exchange properties at different times. However, the sale of one property and the purchase of the other property has to be what is referred to as mutually dependent parts of an integrated transaction. In a reverse exchange, you buy the new property before you sell the old property. Sometimes this involves an exchange accommodation title holder who holds the new property for no more than 180 days while the sale of the old property takes place. Finally, there is an improvement exchange. This type allows the taxpayer to use profit from the sale of an existing property to fund improvements to or building of a new property. This type of exchange, sometimes called a construction exchange or build-to-suit exchange, can be especially tricky to navigate. So again, make sure you consult with a tax pro as advised earlier. So as we finish up the discussion on 1031 exchanges, keep in mind another important point. The taxes are deferred, not eliminated, and in theory you will have to pay them at some point. But remember how I said they can be deferred indefinitely? Well, one way to do this is to again buy another property at a later date, and indeed this is what real estate investors do, rolling the tax liability into another property and then into yet another property, deferring the taxes essentially forever while growing the real estate holdings and earning income from rent. When the investor dies, their heirs may avoid the taxes by inheriting the property as the stepped-up basis, thus the tax may potentially never be paid. The bottom line is that the 1031 exchange is a powerful tool, but there are a lot of details to what is essentially a straightforward process. You will definitely want to consult with a real estate, an accounting, or tax professional anytime you're considering a 1031, but hopefully now you at least have a good idea what's involved. Okay, hope you enjoyed this video and got a lot of value out of it. If you did, drop a like and be sure to subscribe to the channel. And I will see you all in the next video.